Hello and welcome to our FAQ series in accounting. The focus of this session is to understand the deferred tax and deferred tax asset. We'll recap what is deferred tax and what is the effect of deferred tax assets on the financial statements. As we saw in the previous discussion, deferred tax is the tax on the difference between accounting profit and tax profit arising out of the timing difference, and the timing differences arise due to the changes or different accounting policies or the policies adopted for accounting and policies adopted for tax calculation. Some of the common items are depreciation, amortization related items. Once the deferred tax is calculated, the deferred tax is shown in the income statement, and we'll see in this session the deferred tax may be positive or negative, and the current tax is the tax calculated as per the tax laws. The cash flow statement will show the actual current tax calculated as per the tax laws, and the balance sheet will show either the deferred tax liabilities or deferred tax asset, or a net of deferred tax liabilities and deferred tax asset. So in this example, which we discussed in the previous presentation, we saw there was a deferred tax liability. Why was there a deferred tax liability? Because the amortization in the tax statement was 30,000, whereas amortization in the income statement is 20,000, and deferred tax is positive, and that is the deferred tax liability. Why was there a deferred tax? Because the amortization for taxation was 30,000, where the amortization for accounting was 20,000, and this we consider as a timing difference. Now let us assume that suppose that the accounting amortization is 20,000, but amortization for taxation is 30,000. If that is the case, the amortization in accounting continues to be 20,000, and amortization for taxation is 20,000, because it will be charged from the next year. If that is the case, then the tax amount changes. When the taxable income increases, the tax, which is also called the current tax, rises, and the current tax will be shown in the income statement. But the deferred tax will be now the difference between the amortization for tax and the amortization for income statement, which is now negative 4,000. This negative 4,000 can be shown as a DTL negative, and or this can also be shown if we just copy this and put it here. Instead of showing deferred tax as a liability here, suppose we copy this and we can also show that as a deferred tax asset. Cancel. Okay, so deferred tax asset 4,000, and the deferred tax asset is 4,000. The total of the balance sheet will be 50, 109 and 3,000, and the total of the source asset side will be also 189. But observe that here in this case we show deferred tax liability as negative, or we can show the deferred tax asset as 4,000. But independent of the fact whether DTL negative or DTA positive, the current tax 15,000 and the DT as a negative 4,000 is shown in the income statement. And as you mentioned, the current in the cash flow statement, the current tax will appear as a payment. So in case where the amortization in a tax statement is more than the amortization in the income statement, there is a deferred tax liability. And if the deferred tax liability will be shown on the balance sheet, but if the amortization in accounting is more than the amortization in taxation, you'll have deferred tax asset. But in case in a particular year, if both deferred tax liability and deferred tax asset appear, then accounting standard allows that to be adjusted or net off. So instead of showing DTL and DTA as a separate item, one can also adjust the DTL against DTA or DTA against DTL. So therefore, the amount of deferred tax, which is the tax on the timing difference, appears in the income statement as a negative or a positive, and accordingly in the balance sheet it will appear as a DTL or DTA. In one of the future sessions we will try to understand what is this DTL and DTA. Is it a liability or an equity? Thank you very much.